converted into long-term capital. The key lies in whether a country's economic and financial environment is stable and profound. At present, the supply and demand of China's A-share market is seriously unbalanced. In a capital is king market, if hot money is welcomed, it will play a positive role in stabilizing the stock market and releasing the pressure of untraded shares. With the enrichment of financial market levels such as the launch of the GEM and the development of the private equity investment market, the A-share market may achieve the effect of smoothly evaporating excess capital, including hot money, in the process of marginalization. Financial crisis. Paying for the industrial upgrading. Nowadays, with the outbreak of global inflation, making good use of hot money will be the fundamental factor in winning international competition. As the cost of a factor continues to rise, international competition has shifted from price to value competition. Therefore, with reasonable guidance, hot money can be the best source of finance to pay for the transformation and upgrading of Made in China. Secondly, the wave of globalization has briefly receded, and selfishness, narrowness, and opacity among countries are becoming increasingly prevalent. Countries' protection and competition for resources, including capital, will also become increasingly fierce. However, it is clearly not in line with the laws of economic development to bombard China with money that actively flows into China. In fact, facing the highest global inflation in over a decade, Asian countries have significantly tightened their finances, and some major infrastructure projects worth billions of dollars are facing shelving. In a sense, the Chinese miracle in recent years has been the clever use of the world's hot money at that time. After the Cold War, there is a widespread phenomenon of overcapacity in developed countries, and the marginal benefits of enterprises have sharply decreased, resulting in a large amount of international hot money aimed at finding cost depressions. It is understandable that China, with its abundant labor force, has caught its attention. But what is more important is China's active investment strategy under the reform and opening up, especially attracted by preferential policies such as taxation, labor employment, credit, and laws and deregulations, and even sacrificed a lot of economic sovereignty, sold state-owned assets at a low price, and a large amount of enthusiasm money was able to be invited into China and eventually cooled down, taking root. To this day, although the advantages of labor and taxation are no longer present, the renminbi has appreciated slightly towards the outside world. The unity of domestic depreciation still lies in China being a value depression for resources such as oil, grain, and coal-fired power. At the same time, the excess capital from the manufacturing industry, in the previous round, is being replaced by larger scale and higher risk excess financial capital. Hot money is like a barrier lake, once again testing China's ability and courage to flood control. In fact, in terms of the characteristics of the Chinese economy itself, there is a possibility of causing hot money to change. One Chinese economy, the plate is large and the country's ability to organize capital and resources is the strongest in the world to deter hot money. The reality of Carlyle struggling for 3 years and still losing to XCMG has made the entire private equity PE industry cautious, to the point that unless 99.9% believe that the central government will approve, never make a transaction public. To the policy price difference between funds and resource goods can lure hot money and cool it down. At present, the appreciation of the RMB, plus the interest margin between China and the United States is equivalent to a 1-year risk-free return of 12% to 14%. And the international and domestic oil prices are times worse. Whether it is on the Chinese bank account, or entering the downstream field of petroleum and petrochemical industry, or relying on oil transportation in industrial processing, the flexibility and secrecy of hot money will be reduced. 3. The imbalance of 3 parts of the world can utilize hot money to precipitate it, compared to the monopoly of state-owned enterprises and the strength of foreign enterprises. Private enterprises have taken the lead in entering the winter in this round of inflation and tightening environment. First, private oil companies have packaged and married out, and then tens of thousands of enterprises in the Yangtze River Delta, Pearl River Delta, and other regions are struggling, prompting hot money to flow to the private lending market in China's coastal areas and become stakeholders. On the other hand, the clever use of the previous round made this time not aimless, such as in the areas of road and bridge transport, increase investment attraction services in infrastructure construction, undertaking and upgrading new industry transfers. However, in the previous round, taking advantage of excess industrial capital generated significant returns, but the cost of resource and ecological overdraft was also significant. This time it was excess financial capital. Therefore, while utilizing it to vigorously develop the capital market and build a financial center, we had to actively avoid potential energy consumption and environmental protection costs, as well as the inherent negativity and uncertainty of financial capital. On the third hand, after the subprime mortgage, international hot money flooded into the international futures market, rapidly pushing up the commodity price list. Hot money is not inherently hot money. Long-term capital can be converted into short-term capital under certain circumstances, and short-term capital can also be risks, while enjoying currency appreciation. Entering speculative in the real estate and stock markets. There are also long-term capital entering through hot money channels due to capital control. In short, if simply referred to as hot money and blindly pursued, it would actually lead to the formation of consistent expectations, leading to a concentrated and large-scale collaborative withdrawal. In fact, China's capital account shielding and short-selling mechanism are not sound. Coupled with the world's largest foreign exchange reserves, be prepared enough to make any rational hot money dare not have irrational delusions and restlessness. However, it is worth noting that this view of pouring hot money into China has elevated it to a high level of financial conspiracy and war in developed countries, which seriously affects the management and understanding and grasp of the situation, and even interferes with China's economic and financial decision-making. The SAFE reversed its stance within a day, from relevant officials claiming that there is no hot money in China to denying this view represents the SAFE. The 180-degree turn essentially represents the cognitive extreme from financial openness theory to financial conservatism theory. The existence of hot money indicates the attractiveness and growth potential of the Chinese economy as well as the advantages of a safe haven, which have been surpassed by international capital. It is generally optimistic, so it has become another barometer of China's economy. If people are afraid because of too much money, conservative because of fear, and strengthen financial capital control because of conservatism, they will not only control hot money, but also control the charm and potential of China's economy. After all, throughout history, rising to the world through one's own strength is a false proposition. There has always been a saying that war created the United States, as during the two world wars, the United States expanded its economic strength by engaging in arms trade between the warring parties. Not only that, the two industrial upgrades in the United States in the last century, represented by large-scale integrated circuits in the 1980s and the Internet in the 1990s, were not completed by self-reliance, but were transferred by the Plaza Accord. The estimated wealth of the United States from Japan ranged from $300 billion to $800 billion, and the Asian whether China can accelerate depends on how it treats hot money. Although various experts and scholars have varying opinions on the scale of hot money flowing into China, at least hundreds of billions, and at most equivalent to the threat represented by hot money in the scale of foreign exchange reserves, has already stirred the sensitive nerves of relevant regulatory authorities. The financial conspiracy theory is popular. In addition to making hot money eager to escape and rescue the culprit of the A-share crash, there is also the classic fear of hot money fleeing after backhand shorting the Chinese stock market and property market. So on June 7, 2008, the central bank raised the reserve requirement ratio by 100 basis points with unprecedented strength to cope with the sudden and significant increase in foreign exchange reserves, with a record monthly increase of $74.5 billion in April. Subsequently, on July 2, the three departments jointly issued and implemented the Export Receipt and Settlement Online Verification measures. On July 8, the National Development and Reform Commission issued a notice requesting strengthening the review of the authenticity of FDI projects. In addition, the FDI module of the Foreign Exchange Business Information System has also been promoted and launched nationwide. The intensity of encirclement and interception reflects the urgency of the hot money problem and the fear of relevant parties towards hot money. For Chinese people who are not unfamiliar with the hot money-style financial crisis, this high level of vigilance is indispensable. However, the problem is that the severe imbalance in the economic development of both Mexico and Southeast Asia was the breeding ground for Soros to cause trouble, and it was simply attributed to the shameless and selfish nature of international speculative funds, undoubtedly putting the cart before the horse. Treating hot money as a wild dog and shouting in the wrong direction is clearly wrong and carries the risk of system consistency. In fact, under the condition of capital control, the scale of hot money flowing into China has always been a mystery. In addition to the balance of total foreign exchange reserves after deducting trade surplus and foreign investment, trade and direct investment items themselves are becoming an important way to disguise the inflow of hot money. In the first quarter of 2008, China's FDI grew abnormally by 72%. Moreover, these funds are not all evil, nor are they all organized and premeditated, but may be acting independently, such as pursuing profits and avoiding